The US consumer is tapped out, they're burning through their savings, and they're cutting back on spending. If you spent any time on Twitter lately, you've probably heard some so called macro experts tell you this. And while there may be some truth to this, I don't think things are as bad as a lot of the bears are saying, because we'd see it in the stock market, and we're just simply not seeing that right now. We're actually starting to see a lot of strength from the consumer discretionary group. So you can see what I mean in the chart below. So this chart shows the performance of XLY. This is a consumer discretionary ETF. It invests in a basket of consumer discretionary stocks. These are stocks that sell things people want. So think things like electronics, clothing, vehicles. So these are things people can live without, but if they're really in a situation where they have to cut back spending and they're really tighten their purse strings, this is an area that should be getting hit hard, but it's not. So you can see what I mean in the chart below. So when we look at the weekly chart of XLY, we can see that it topped right around when the market did in November of 2021, pulled back, and actually broke below briefly its pre-COVID high. So it broke below that level. You had a little flush, but quickly, got back in track and was able to reclaim that higher time frame support. So essentially, had a false breakdown at the pre-COVID high level. So that's a positive. It's also built out this massive inverse head and shoulders pattern, which is a bottoming pattern that we've seen a lot of stocks and ETFs put in lately. And many of the stocks that we've been looking at that have put in this bottoming structure have broken out to the upside. So there's really no reason to think XLY won't do the same. We also like that XLY is above this 30-week moving average and a rising 10-week moving average, and it's also broken out of this mini base that it's been a few weeks forming, and now it's back a bit above the downtrend line that it was in since November of 2021. So all in all, really positive price action we're seeing on XLY on an absolute basis. We also like what we're seeing on a relative basis. So this chart compares the performance of XLY with XLP. XLP is a consumer staples ETF. So that ETF invests in companies that sell things that people need, like shampoo, soap, cereal. So if the economy and the stock market was about to crash, imminently, I don't think we'd be seeing this ratio break out to the upside. So this means that consumer discretionary stocks are now outperforming staples again. And you can see this had this triangle wedge pattern here, broke out to the upside. And all in all, it's looking really constructive. And again, it's very unlikely that we'd be seeing a rotation out of staples into consumer discretionary stocks if the whole market or the whole economy was about to fall apart. We also see a lot of strength when we look at individual consumer discretionary stocks. So this is Amazon. I don't think Amazon needs much of an introduction. The giant online retailer bottomed in December of 2022, so December of last year, and then had a huge rally off that level, pulled back, put in a higher low, and has since broken out, and now is back above this area of resistance here. So all in all, looking very constructive. It's trading at multi-month highs, trading at the highest level since October. And it's actually, if you look at its 12-month performance, it's slightly positive over the past 12 months. So not the sort of thing you'd be seeing if the economy was about to implode or the stock market was about to implode in the next few weeks. You just wouldn't see Amazon up over the past 12 months. Another stock that we're getting an interesting signal from. So this is Home Depot. As you may have saw a few days ago, Home Depot released its earnings, and it had its worst revenue miss in 20 years. And it also lowered its revenue forecast for the year. So a lot of bears were out, and they were, just using the Home Depot earnings report as an example and proof that the consumer is totally screwed right now. But you can see what happened here. So it's initially sold off on the news, but then buyers stepped in, and we saw heavy buying volume on that flush down. And then the next day, we saw a big follow through and actually closed the following day above where it was the day heading into its earnings report. So again, how bad can things be, and how bad of an earnings report could it have been for Home Depot if it didn't even sell off on the results? It was actually able to reclaim that level right away. So that's a positive for us, that you're seeing some consumer discretionary stocks reacting favorably to bad news. If we were in a real bear market and the economy was really about to implode, you just wouldn't be seeing that sort of price action, that behavior in stocks like Home Depot. We also have some new leadership in the space. So this is Celsius. This company sells their energy drinks. I've actually never had them, but they're quite popular. A lot of people drink them instead of coffee, and we can see that it had a big run beginning in March of this year, rallied strongly into its earnings report, and then when it delivered earnings, it had a power earnings gap that actually sent the stock to new all-time highs. And since then, it hasn't given back any of those gains. It's actually been edging higher. So overall, super strong price action. And this just is what you want to see from a sector and industry group. You want to see some new leadership. And that's what Celsius is looking at right now. Another stock in the space that's showing interesting leadership is Ferrari. So this is the ticker RACE. Ferrari is a company similar to Amazon that doesn't need much of an introduction. They sell luxury sports cars, the sorts of sports cars that I can't afford. But interesting price action here. We could see that the stock bottomed in last summer, so well ahead of the indexes, and then put in another bottom, another higher low down here, and then rocketed off that level, and has since broken out to new all-time highs. So really positive, bullish price action out of Ferrari. And if there's one takeaway from this chart and from this stock in particular, it's that the high-end consumer is definitely not struggling. So if you're worried about them, I wouldn't be too worried about it. As far as new potential leadership, stocks that haven't run up a bunch yet, one name we're watching is Mercado Libre. So this is the Amazon of Latin America. Provides online shopping and some logistics similar to what Amazon provides in the United States. And we could see that, it bottomed in June of last year, so bottomed well ahead of the indexes. That's something we like to see. It's reclaimed its rising 30-week moving average, and its rising 10-week moving average is acting as support. Right now, it's bumping up against resistance at this key level, but if it can flip this level, that'd be a major change in character for the stock. So overall, that'd be a very bullish development. So that's something we're watching here. It had earnings, I think, a week or two ago. It initially sold off, but really recovered strongly on its earnings reaction. So back trading near its March highs once again. So if it can break this level, this is definitely a name to watch in the consumer discretionary space. But all in all, what we're seeing from discretionary is a few things. One, I just don't think the claims about the U.S. consumer being totally screwed are being validated by what we're seeing out of consumer discretionary stocks. And this is also an area of the market where we could see some rotation, while areas like tech, within tech, semiconductors and software names have had a lot of big runs lately. Consumer discretionary stocks seem to be just getting warmed up with just a few leaders breaking out, and names like Mercado Libre have the potential to emerge as new leaders. So definitely an area to keep an eye on. So yeah, that's it for today. Hope you found this video informative.